Welcome to Chit Chat Stocks. This is our weekly Power Hour episode where we discuss all things financial markets, all things investing. We're wrapping up earnings season here, so we've got some fun segments around some of the best earnings reports we saw in Q3. Doesn't necessarily mean we like the stock, but we're going to go through some of those because there were some stocks that really jumped this earnings season. I'm talking about doubles after reports. So big swings. So we'll go through some of those. And then we've got a lot of other fun topics for this week. There was a Saga with a DNA testing company that'll be fun to discuss. And then Spotify, one of our former holdings, is doing quite well without me as a shareholder these days. So we're going to talk about that as well. Before we get to that, I guess I am joined, as always, by my co-host, the one and only Brett Schaefer. Brett, how are you this morning?
Doing well, Ryan. And I have to say, is the bubble back?
Yeah, I think it is. I was thinking about making that like the whole discussion today is we're bubbling again. Um, but honestly, I don't really want to go through all the data. It's more so just feels anecdotal that all these valuations are soaring and on a lot of companies that I think are a little bit suspect. So yeah, it feels bubbly. Reminds me of 2020, 2021 period. Um, Didn't really have any data on it, so we can talk about it. Bitcoin is soaring, which is usually kind of a leading indicator, in my opinion, for investor sentiment, for getting into potentially speculative assets. But that might be a hot take, and I know we don't want to be. We'll get plenty of flack for being anti-Bitcoin from listeners, so probably won't want to make that the entire discussion today. But before we get to this episode and before we talk about some of the best reports from this earnings season, we do want to mention our sponsor, our partner, Public. Heads up, folks. Interest rates are falling, but you can still lock in a 6% or higher yield with a bond account at public.com. That is a pretty big deal because when rates drop, so can the interest you earn on your investment. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments, but you might want to act fast because your yield is not locked in until you invest. The good news, it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks. Side note, I did this. I signed up using our own link, so a little bit of helping ourselves there. But yeah, it's a very seamless process, very easy. I actually went with the high yield savings account, which they offer a great rate there as well. But yeah, they offer really good products, especially if you're looking to find something that's high yield, a little safer. A lot of really, it's a very interesting platform. Honestly, I did not know that much about it until I really signed up and went in there. So really recommend checking it out. But back to the show here, Brett. Where do you want to start?
Why don't we go through your main topic? I know we weren't really going to talk about the bubble because we got some fun stuff along with that I think will lead into some potential bubble discussion, but we're going to look at five each impressive earnings reports. Maybe you could list off all five. I don't know how you want to go through this because we can't do all 10 in detail, but what were some earnings reports that caught your eye this quarter?
Yeah, and so the I guess the impetus or the inspiration for doing this segment is I obviously work at FinChat. For anyone that doesn't know, it's a stock research platform. They're one of our sponsors. I work there, and one of the big things, or one of the things customers love about FinChat is the segments and KPI data, so tracking company specific metrics. And I basically went through as much as I could all the company specific segments and KPIs and tried to figure out what were the most impressive KPIs from this quarter, like what random metric really jumped from any company. And there were a couple that really stood out. So um, Google, for one, was very impressive. I mean, they're pretty much impressive across the board in terms of their earnings report. And if you listen to that call, you will quickly realize that this has to be the best digital moat in the world. It's what was it? 7 products now that have more than 2 billion monthly active users. So, I mean, if there is not a digital moat there, I'm not sure there's anything. I don't know if the word digital moat is justified at all. Like, I don't know if anyone has a digital moat if Google does not. So, anyways, good quarter, but the KPI that stood out to me was the Google Cloud. Google Cloud's operating margins went from 11.5% to 17.5% in a quarter, and revenue growth actually accelerated as well. So the last quarter, I believe it was 29% growth rate, jumped to 34. So really strong quarter from Google. That stood out to me. I'll go through, maybe we can ping these off each other. I go one, you go one, so I don't have to ramble through five and we can have a little dialogue here. What's one that stood out for you?
Well, I think this one was yesterday or earlier this week, and it was Rocket Lab, a company that we covered in an interview with Simon Erickson, I think not too long ago. And the stock has, let me just check the performance real quick because they have turned into a bit of a momentum stock over the last year. It's up, 360%. And a lot of that has come in the last few months. So a lot has changed. And why has it? Well, I have one chart here that I think can help, and I'll share it with everyone. And it is the backlog for the company. For anyone that doesn't know, it's a SpaceX type competitor. They're trying to build out rocket launch capabilities, and they have built out some rocket launch capabilities as well as, the space systems and services that go along with it. So we can see here their backlog has jumped to about $1 billion, which is significantly higher than their trailing 12-month revenue. So they should have quite a bit of predictability and quite a bit of customer commitments to help them build out this really tough business that takes a lot of capital expenditures. They got some major updates on their bigger rocket, which is going to be called the Neutron, which is about the size of the Falcon 9, I believe. And that one has already gotten some customer commitments. So we're seeing an increased, not an increased, further progress on the timeline there. And then they also disclosed that they're going to be building out their own satellite constellation, which I didn't really read anything into that, but they disclosed that for, people had hinted at that before and predicted that that's what they were going to do, but now they confirmed it. They're going to be investing in that, and hopefully they can keep up the momentum. But I will say, looking at the stock today, price of $20 a share, market cap is $7.3 billion. There's going to be further dilution and more debt because of the build out. It's an aggressive build out. They're losing money right now. $7.3 billion market cap. I'd maybe even put that at, if you want to estimate some full dilution, like $10 billion. That's going to happen over the next 5 to 10 years, something like that. The revenue over the last 12 months is only, I think, let me just confirm it here. Yeah, $364 million. Something like that.
It's a steep valuation.
Yeah. Now they have a clear runway to get to $1 billion in revenue when they add on all these things that they're planning, and they already have those customer commitments. But I kind of feel like today a lot of that's priced in. Would I be selling if I bought Rocket Lab 400% ago? I think that's a different question, but am I buying today? Probably not.
Yeah, this is definitely a company that I'm rooting for from the sidelines. It worries me because people fall into this trap all the time, myself included. You get a stock, or especially if it's kind of a flyer, you're taking a chance on a company where it's more of a concept company, but the revenue could be there down the road. Rocket Lab, they already have some revenue, obviously, but um, certainly you're probably buying because of the potential for their services in 5 to 10 years. When you start talking about diluting shareholders as a good thing and how it's actually advantageous because it's going to give them the capital they need. Yes, that is true. But man, is that bubble talk, because it's it just reminds me of 2020 when they're like, yeah, I know we're diluting shareholders, but we're going to generate great returns on this capital that we raise. And it's actually better for you that we do it now. But it's also simultaneously admitting we trade at a premium and it's the right thing to do. So, and I'm
It's
not
good
sure if
if you
this is,
bought at $5 a share. I would
Yeah.
say it's not good when thinking about whether to add to your position. And I think Rocket Lab is a perfect example of when you have a high risk, high reward stock that you find, doesn't mean you necessarily shouldn't buy. Now, if it's not your style, it's not your style. But if you think if you like the company, you think it's exciting, you think there's a chance it could be a 10, 20 bagger, make it a small position, maybe even less than 1%, 0.5%, something like that. And as it either works or doesn't, it will become a larger percentage of your portfolio as it de-risks, as Rocket Lab is potentially doing. And if it doesn't work, well, it's not going to blow up your entire retirement savings.
Yeah, I think that's a good way to go. All right, I'm going to go with my second company here that I thought had an impressive third quarter report. Screen share here. Philip Morris International. Obviously, I think we're both shareholders here. I
That
am
is
a
correct.
shareholder.
Yeah, Ryan, I think this is your favorite company now.
It
I
might
would put
be.
this on, there's the size of a position versus like how much someone talks about it. And I think I would, if I had to say what were your favorite companies you own, this is definitely number one.
Yeah. Yeah, I mean, it's kind of a fun story to tell. This kind of storied brand has become the innovator, I guess. Well, they acquired the innovator, but whatever. They were the innovators in some way. Um, but they've really built out a pretty impressive reduced risk product portfolio. And I'm not just, I know we talked about Google, we talked about Philip Morris, or I have, and it maybe sounds like I'm talking my book. All these companies were objectively had good Q3 reports because market thought so. That's what I'll say. It's not just me thinking, oh, this is a good report and the market got it wrong. Pretty much, I think every stock we have on our list here jumped quite a bit after earnings. Philip Morris was no exception. So good quarter all around. I think it's a very durable business, assuming there isn't any sort of huge regulatory headwind. But even then, I think they'll be able to circumvent it a bit. So, yeah, margins have improved a lot. And the cigarette portfolio is basically flat, which is kind of the best situation you could ask for if you're a shareholder in here. You're not expecting volumes to really increase or grow that much in the cigarettes. But as long as they're flat, they're going to be able to raise prices and hopefully
And I
improve
wouldn't
profits.
expect it's gonna reverse to downturn again. The volumes are going to decline.
Yeah, and
This is just a nice period.
yeah, and it's not as pronounced of a decline as the US market. We're not seeing the volumes even the 3 years prior to this little blip where they've had flat volumes. Cigarettes were declining, I believe, kind of 1 to low single digit percentage, whereas we've almost seen an accelerated period for Altria, who has the same brand but in the US. Anyway, I'll leave it there. Thought it was a good report. Philip Morris, yes, it is one of my largest holdings. Um, but yeah, I should probably not talk about them every single episode.
Yeah, if there's a drinking game, I know some people want to talk about one that is perhaps my drinking stock, not next, but the one after that. But yeah, if Ryan mentions it, maybe people are required to drink. Uh, let's go to mine, Spotify, second one. I thought it was an impressive earnings report, and I really just want to hit one KPI, and the rest of the report seemed quite in line, although I guess the premium gross margin beat a little bit. And this is their quarterly GAAP operating margin. Well, I guess they might be IFRS. Either way, if we look at this chart, which I'm sharing here, back in 2022, early 2023, operating margins were negative. And then Spotify cut 30% of its workforce. The business didn't really change. And now we're at 11.4% last quarter when people thought that this company would never be profitable. And lo and behold, since every stock seems to be mooning, it's up 5x since the lows. Not a bad, it's been a roller coaster ride, but I think this is the quarter where the thesis finally got 100% proved for the long-term shareholders. We've been shareholders for Spotify before. It's a company I like. I think Ryan likes it as well. I don't know if this is the price we would be buying at for sure, but it's a psychological long for me, similar to Google. And I kind of, people might not know that term. It's a play on something that Bill Ackman did, kind of drama queen stuff. But it I think of my psychological longs as the one that I might not even be buying, but there's so much hate against the company, a lot of doubters in the investment community, and I think they're completely wrong. And then when that gets proven wrong, it's almost like a just nice to be proven right, even if you don't make any money. Now, would I rather just make money and people think I'm wrong all the time? Yeah, I would rather have that. But this one is also, it's fun too.
Yeah, unfortunately, we don't have that luxury. It's no, it's a good quarter from Spotify. I'm not a shareholder. Wish I was. I got all of the losses and seemingly none of the gains. So it's had the rough ride as a shareholder, but um it's expensive here. It's really kind of a commanding valuation. What it does show, in my opinion, is that you don't need that high of a gross margin to be able to generate strong profits. I mean, now Spotify's gross margins did improve. I think they went from like 28 to 29% to 31% this quarter, but you've really seen good cost controls as within the operating expenses, and that's really what's driven this huge operating margin inflection. Um, I think it just goes to show that actually, if you have a low gross margin, sometimes it's the whole your margin is my opportunity, and you can go out there and really drive a big business even at a low gross margin and generate strong cash flow just purely by operating efficiencies. Part of this is also the full-time employees have come down considerably at Spotify, which is, I assume, one of the leading drivers of this margin expansion. But yeah, 12% free cash flow margins, 11% operating margins. Actually, 12% was, I think, trailing 12 months, so it's probably even higher this quarter.
It was 11.4% this quarter. Or sorry, were you
The free
saying
cash
gross?
flow.
Free cash flow? Oh, yeah. Not sure on
Um,
that. They do have the working capital stuff, so I really try to look at gap operating margin. And the one thing is there is finally a breakout in premium gross margin, but the advertising business is doing quite poorly. So it's despite some sluggishness that could maybe even improve over the next 5 years if they finally figure that out.
yeah, it's funny. It was actually when we were owning Spotify in 2021, advertising in my, at least for me, I thought it was going to be a bigger piece of the pie here, especially 3 to 4 years out. We were very optimistic that they were going to become sort of the YouTube for podcast ads. That has not played out. It's still a very fragmented market. We're going to talk about that here in a second with my small cap of the week. But it's, yeah, it's been execution on the premium side. Actually, premium ARPU is up as well. I think it might have hit at least a 5-year high. So they've been able to, those price increases are kind of coming through and flowing through also. So yeah, good execution across the board. Let me hop to my third company here because I know we're running slightly long with this segment. The company is AppLovin. I will admit, I don't know this business very well, but
I've never known what this business does.
so I guess they help, those scammy ads you get if you're playing like a mobile game.
Yeah.
I think that's basically their business. Not really, but that's part of it. So they help mobile game developers monetize essentially. So part of it is in-app purchases as well as advertisements. And the funny thing here is, so I think AppLovin's up like, maybe you can check this for me, Brett, but like it was up like 50% after the earnings report.
Wow.
The in-app purchases and the in-app advertising revenue were both flat to down year over year. Yeah, I'm looking at, yeah. So in-app purchase revenue down year over year, in-app advertising revenue barely up, but apparently they have this platform. It's a software platform for I think advertisers or developers. Maybe it's a combination of the two. That's very, apparently it's been like a huge AI success. It's called Axon. And it has
What's the chart you're showing here? Like,
This is
what are the numbers?
Like what's the metric?
Yeah, it's just hard for people to see.
It's the software platform revenue. So the three revenue drivers for them are in-app purchases, in-app advertising, and then the software platform. 2 years ago, in-app purchases were a big driver of it. This software platform, which is really that Axon AI advertising interface, has absolutely ballooned. it's doubled in a little over a year, and you can see the big jump that they took this quarter. So apparently they're having some success with this. They've been probably one of the biggest, I guess, AI successes, it seems, as far as actual pure monetization. So once again, don't know the business intimately well, but this quarter really stood out, especially this KPI, which seems to have just taken off. And curious to see how this goes, because it seems like a lot of people have kind of flooded into this stock after the earnings report. Were you able to see how much it's up following the report?
Yeah, it was about 50%. It went from 160, I'd say, to 284, and it is up 632% in year to date. Market cap is now approaching $100 billion. That's interesting.
Okay.
A
Well,
lot of
we'll
stuff here,
see.
Ryan, is up 200, 300%. And you have to know, all of the listeners, I think, were here in 2021. Just remember that things can turn south.
Yeah. And yeah, people that are saying, well, it's coming from the fundamental improvement. The fundamentals can change. This could be driven by like primarily a strong advertising market. Eric in the comments says, your friends at Chip Stock Investor have a good podcast on AppLovin. Noted. They are our friends. They do great work, and I will have to listen to it. Unfortunately, that valuation does kind of deter me from doing a whole lot of research here, but
I'm sure they cover what the business actually does instead of us going, huh, what's an AppLovin? But
yeah,
all
definitely.
right, let's hit my third one. And it is the one that I was teasing that I talk about all the time. Maybe my number one psychological long, because there's still people that doubt the thesis, even though it's been a 10 bagger from the COVID lows. And that is Sprouts Farmers Market. Had a great report. And I'm just going to highlight one KPI that is from our friends at FinChat, which you can go check out with our link in the show notes, finchat.io/chitchat. You get a discount. We've talked to people plenty of times that use this service, use our link. It's going to provide you so much time saved and efficiency and just improvement during earnings season. All right. I was doing that ad pitch because I wanted to load up the comp sales chart. And as we can see here, Ryan, they recovered after kind of the COVID bullwhip. Comp sales went to about 2, 3, 4%. And the last few quarters, it's just absolutely exploded higher to 6.7% and now 8.4% for the quarter ending in September 2024. And if we compare that to 2023, that's 8.4% comp store sales growth on top of 3.9% in the same quarter in 2023. I think that's just highly impressive, and it shows that, hey, the business model is working. More people are coming to the stores, and stock, unsurprisingly, is up. That's a theme, I think, for these ones. Let's see what it's up year to date or in the last year. It is up 250% in the last year. So there we go.
Yeah, this one. Well, I was a little on the fence with the performance, just because there is the chance that maybe consumer spending there's been this resurgence, and it's really kind of helped power the business, and that's part of what the comp sales strength was from. But now 9% comp store sales growth on top of strong sales last year, you can no longer say, because people used to look at this and they'd be like, wow, inflation's out of control. And it's like, no, that's that's partly their execution. But yeah, when you've got them outperforming comp store sales of the big grocers like the Walmarts, the Krogers, the Target's not really a grocer, but Costco as well. It just goes to show the execution. Not to mention they're doing it while generating record gross margins. I think it's at high 30s, 38, 39% gross margins, which is twice that of the typical grocer. So yeah, I think the execution there has been solid. This is really all your psychological longs list. Do you own any of them?
I don't own the ones I put down, but I do own some of yours. One of them,
Okay.
I think your last one as a tease, is one that has benefited from this. But I typically look, there's a lot of stocks on my watch list this year that I didn't buy because I was worried about valuation and profitability. And these stocks have put up impressive revenue growth. I think the business model fundamentals are still in question, Rocket Lab, Hims and Hers, stuff like that. But we're in a period right now where revenue growth is all that matters. I think that is one of the big indicators for me that 2020 and 2021 is back.
Yeah, that's fair. And it's nothing like there's no overarching data that I'm looking at. And I'm sure you could find some just in terms of the average multiple across NASDAQ or whatever. But every company I look at lately, it just feels like you get to the valuation work and you're having to improve some of your assumptions to make the math work. But my number 4 here, and maybe we can go a little quicker because I know we've taken up about half the show doing this. Number 4 is going to be Axon. This is a company they sort of, not really, but they sort of invented or commercialized the taser. And they've actually just done a phenomenal job executing, not necessarily on building just crazy good products that got good adoption. A lot of the time it was purely like customers would come to them and ask, like, can you build this? They've sort of the whole like build solutions, not products. They seem to have done a really good job with that. Software revenue has continuously grown. It's the lion's share of their business today. But really the strength here was actually from the taser division. Their tasers have like 60% gross margins. And that grew faster than software this quarter. It's a little more cyclical just because they release a new like Taser 10 or whatever the new model, and then it gets a lot of demand, a lot of like purchases at the moment. So it probably won't grow faster than software over a 5-year span, but yeah, good quarter from Axon. Stock is once again up like 300%, if I'm not mistaken, over the last year or so. So not really looking to buy, but good quarter.
Yeah, I agree. And without getting into any sort of specific political or government stuff, there is perhaps a sector tailwind that should continue. All right. My 4th one is another stock up 400% in the last year, and that is CAVA, the Mediterranean Chipotle. Chipotle. Yeah, I can't say it. I definitely not Chipotle, but Chipotle. All right. CAVA comp store sales. I'm going to use that one again. We accelerated back to 18% this quarter, Ryan. And that's on top of, again, in October of 2023, 14% comp store sales growth. It's just really, really good. Really, really, really good. And maybe we'll go into details on the earnings. I actually had separate notes on them for the earnings. I can read out some of them. Just some quick bullet points. 39% total revenue growth, 13% traffic growth, 26% restaurant level margin, positive net income, and free cash flow. They have 352 total stores, and they're valued at about $50 million per store right now. And based on their AUV and restaurant level cash flow margins, that's about $700,000 in store level cash flow per year. So they're valued at about 71 times their store level cash flow. But a question here, are you buying? And I would say the answer is clearly no. It seems overvalued.
Yeah, this is really impressive results, especially considering that pretty much the entire quick service restaurant industry had declining comp sales this quarter, and they actually accelerated. It is probably one of the most egregious valuations out there today. Now, I'm not a fan of valuing it based on like the per store, like you said, $50 million per store, because the whole idea here is that they're going to have a lot of new stores. But yeah, I saw something today that basically said like the valuation assumes that this is a company that will be doing, it'll have 3,000 stores. And I think they're at like 300 today. So
352, as I just said.
you're paying for a lot of the growth today, and there's no guarantees it's going to be there. With that said, great concept.
Yeah, but it's just the optionality is limited on a restaurant. Whatever. You go to your last one. We're going long.
Okay, last one was Remitly. They had a really strong quarter. Total payment volume accelerated. They have added more monthly active users in the last 2 quarters than any 2-quarter period in their history. The marketing seems to just be working really well. they kind of take a different approach than Wise, which is they spend a ton on marketing, whereas Wise spends very little of its revenue on marketing, and it kind of just hopes for the network effect. But it's paying off for them because they've been able to grow users much quicker. So um, kudos to them. It's a pretty simple model. They help power remittances, and it's really just kind of a clean story. Like good product helps people send money at a cheaper cost than Western Union and a lot of the other remittance services. Um, and it's got a great mobile app, and tons of people are using it.
Yep. There's a lot of discussion out there, I would say, from some smart investors about how Wise has a better digital platform and back-end infrastructure, which is definitely true. Or I'd say, like, I'm no expert on this stuff, but I'd say fairly confident that is true. The claim is that Wise, with that infrastructure advantage, will defeat Remitly over the long term. But I would just ask anyone, and I know Wise is still a good business, but with Remitly, do you think there's going to be the full elimination of cash payouts in all these other countries that are not nearly as wealthy as the Western world over the next 5, 10 years? No. So they have plenty of time to do it. And it's not going to, their value proposition of basically going where the end customer is and really helping out with that product, is that value proposition is not going to change.
No, I agree. All right, last one for you.
Okay. Little known company, Amazon. I'd say this was another, and I like looking at companies or seeing margin expansion. I think that's been a theme for my list here, is either margin expansion or comp store growth acceleration. And I'll share the screen again. We can look at Amazon's North American operating income. It's gone from negative in 2022 to $22 billion over the last 12 months. If you look at operating margins, they have, what are the consolidated ones, hit about 10%, Ryan? And there's probably room to get to 15% or more, just given that AWS is still actually like a huge tailwind there with about 30% to 35% or higher operating margins. So you can see this inflection. It's finally happening. And what's interesting is that unlike a Meta or a Spotify, it doesn't seem like the company is running that efficiently yet, where they have all these side projects still going on. So I'd be curious to know if they ever get to that. But I guess AWS and third party sellers and advertising are so profitable that investors aren't going to be able to force their hand to do that.
Yeah. All right. Of the 10, who do you think had the most impressive report relative to expectations?
Ooh, relative to expectations. I think Rocket Lab, honestly. But
Fair.
it's not even the numbers, it's their contractual commitments, and that's not showing up in the revenue yet. So maybe if I have to go with the actual numbers, I honestly think the most impressive was Sprouts Farmers Market. I had no I did not think whatsoever they would ever hit 8% plus comp store sales growth.
No, I agree with that. Kavas were also pretty standout.
Yeah.
But yeah, good. All those
All right,
had
we had
pretty
a
good
question
reports.
on Nelnet. Someone said, "Thoughts on Nelnet numbers? I have to admit, I didn't fully understand it." Well, we can't go through it fully, but maybe I'll hit some questions on why the stock is down a little bit, because I did write a little update for the Chit Chat Stocks Substack. So if you want to see the written numbers there, maybe I'll just link it in the chat here. And for anyone, the link is in the show notes. It's all free. You can find it there. Um, what happened were a few headwinds in some segments. So they had the loan servicing division. They were under a new contract, and that division is now unprofitable. So people, I think, are a little concerned about that. If we look at another one, which is the asset generation and management, which is the residual student loan book, plus a few other things, we can kind of look at how they had some write downs on loan securitizations and various debt projects. Nelnet Bank also flipped to a net loss of $5 million due to a recognition of loan losses. And they had some write downs and asset impairments within the renewable energy construction business, which they are going through a transition because they eliminated or decided to get out of the residential solar business and focus solely on commercial stuff. And that's been a sacrifice to profits in the near term because the residential solar business that they bought ended up being a dud. So there were some positives in the quarter, but a lot of negatives. And hopefully this was a one-off, but we can't have this continue indefinitely. We can't have this happen every quarter, or they're not going to be generating value for shareholders.
Yeah, something that's also become a little frustrating is when we first bought this, I thought, man, it's a little complex, but it seems undervalued. If I would say, if anything, it's more complex today to understand all the divisions. You probably don't need to, but yeah, kind of a bummer. A little bit of a bummer of a report just to see the solar investments in hindsight were probably not the right thing to do.
Well,
And
no, the
then,
solar construction business. The solar investments are almost a guaranteed return. That's a separate
y-
division.
sorry, the investment into the construction side of things, because it
Yeah,
was not only acquiring a business, right? I mean, they're running it now, and it's a construction business.
well, yeah, when you acquire a business, you start running it. They acquired that business, it was a total loss, and perhaps they got sold a bag of goods that weren't so hot right when the solar industry went to a giant downturn.
Yeah, it's true. They're not the only solar company that's struggling. Pretty much every single solar business is having their issues. Um, yeah, bit of a bummer on the Nelnet quarter. Okay, we've got some other topics to discuss. I do want to talk about the 23andMe saga. Have you heard about this?
Yeah, I'm pretty sure I had this as a segment a while ago.
Wait, really?
I mean, not recently, but maybe there's something new.
Okay.
It's the Anne Wojcicki, and
Oh yeah.
yeah, they
Well, the big news this week was that she announced that they're going to have to lay off 40% of their staff. But I'll go through the story here in a second. Before we do, I do want to mention our sponsors one more time. Public, heads up, folks. Interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield is not locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks. Okay, just to kind of give a summary on the 23andMe story. Essentially, Anne Wojcicki, hope I'm saying that right, CEO, co-founder, the business was kind of struggling. Business was definitely struggling. They had a massive data breach, which for a DNA testing company seems like one of the biggest issues you got to avoid. Massive data breach. Sales of their testing kits kind of went down the drain. And then they were also trying to build this drug discovery business, which was just hemorrhaging money. So anyway, business was really struggling. And Wojcicki tried to take the company private. The board thought it was not. I believe her plan was to take the company private at a discount to the market price, which is a hard sell for the board. Board was not a fan of it. Board said, well, let's at least look at some third parties, see if anyone else is going to offer it. And Wojcicki, who owns basically 50% of the voting power, said, I will not entertain any offers from third parties. So kind of sounds a bit like a power trip. The board in September, all 7 out of 8, the 8th being Anne Wojcicki, resigned at the same time. There was actually kind of a funny period where if you go to the board of directors page on 23andme.com, it was just Anne Wojcicki, just her picture, which was a little hilarious. They have since hired, I think, a few other people to the board. But yeah, this week they announced that they're probably going to need to lay off 40% of the staff. Any interest in this stock, Brett?
No, but maybe it'll turn into a meme stock if someone starts some fake news around Sergey Brin buying it or Google buying it, because this is a chump change for him. I'm saying market cap $105 million, and Sergey Brin's net worth, I believe, is probably over $100 billion. Let's check it out real quick. According to the Google machine, which helping them out there, yeah, $145 billion. But I don't think they're married anymore. So
They're not. Former
yeah,
wife.
maybe that won't help. Yeah, no interest in this thing. It's
It
I mean,
was,
it's not well run. It's a downside of the Class B share structures.
yeah. And I mean, what are you going to do? Like, there was never, what was the end game here? Like, you sell them testing kits, they're not going to test twice. You sell one testing kit to each customer, you have to come up with a new business in terms of what you're going to do with it. So,
Well, they tried. They just wanted to do drug discovery, and instead of just trying to do one drug or something like that, they try to do a ton at once, which is wildly expensive and
yeah,
probably didn't have the funds for it.
$6 billion market cap in 2021.
Yeah.
Remember those
Hey.
days?
Hey, well, we're
Those
back
were
there, I
fun.
think.
We're back.
I think the IPO market might be opening too. I saw a note that Klarna is going public, and that is, I gotta say, one of my favorite bubble stocks. Buy now, pay later. Can we get Visa down 50% again?
Okay, let's say the IPO markets are back. Number one IPO you want to see? Who is it?
That's a good question.
I'm going
I don't know.
Huddle, just to save my
Yeah, Huddle.
Nelnet investment.
Maybe they'll do that. I doubt it though.
Yeah, me too.
Turo, but I'm out of IAC.
So you don't
luckily,
care anymore?
So I don't care. I would like to see what the valuation, I guess, it gets the fetches, but no, we need. If we look at thinking about the episode we released today, I want IPOs in Mexico. Come on, let's get that market cooking.
Guess that's true. Yeah, that's a good one. All right, what do you want to talk next? You want to do my small cap of the week?
Let's do your small cap of the week. One within our industry.
Yes, a
Interesting.
competitor potentially.
Yeah,
Not really.
Yeah,
we are a minnow in the ocean that they are a large player on. Okay, Ryan's small cap of the week, presented by, drumroll please, Yellow Brick Investing. The company we're talking about today is Audio Boom Group. This was actually a lot of fun to read up on because it is a business model that Brett and I both know extremely well. And I actually found this one on Yellow Brick. So typically I'll get either recommendations from listeners on stocks they want us to look at. And I'll look up the ticker on Yellow Brick, which for anyone that doesn't know is just a aggregator of some of the best stock pitches across the internet. And you're going to find a high quality right up there. Sometimes I'll look up the ticker, or this time I just filtered companies below $1 billion market cap and looked at the most recent write-ups. This one showed up, and here's a quote from a Substack called Spruce Hill Capital, which I found on Yellow Brick. It says, Audio Boom is a global leader in podcasting, achieving over 135 million downloads each month in 2023, attracting 38 million unique listeners. This reach positions Audio Boom as the fourth largest podcast publisher in the United States. So a little larger than us, 38 million unique listeners. We're on our way, but yeah, it's one of the biggest podcast publishers. They are really a podcast network, so I'll explain kind of the nuance there. But some of the podcasts that they have, they've got like the Tim Dillon podcast, a lot of serial, a lot of crime podcasts, Matt and Shane's secret podcast. I don't know, Shane Gillis is very popular right now. He's kind of one of the most popular
that one's
comedians.
always in like the top 5. So I'm sure that one is their number one.
That's a recent one too. Yeah, it's a huge catalog. Apparently they have, they say they own 14 of the top 100 podcasts in the US. It's really not ownership. So the way these work is they go to a podcast host. Let's take Shane Gillis, for example. They say, we'll take all the back end work off of you. And so that includes stuff like editing the podcast in most situations. The contracts can vary, but editing the podcast, finding advertisers, negotiating prices, distributing the show to the different platforms, invoicing for listens, you name it. Basically anything that's on the back end of the podcast, the network is trying to take that off their hands. And in exchange, they get a percentage typically of the advertising revenue. However, the one nuance or difference here between Audio Boom's network and our network is that it's they have minimum guarantees for a lot of the largest shows, which really kind of hurts them in a period where there's down listens, because then you're paying a guaranteed percentage of the revenue, and you're paying out a guaranteed minimum each year. And if listens come down, which in 2022, or I should say following 2022,
yeah.
when the iOS changes happened, which I'll talk about in a second, listens came down, and so we saw profitability shrink. So they report at their peak, they reported $78 million in revenue over a 12-month period. Only 17 million of that drops into gross profits. So it's really kind of a gross revenue versus net revenue situation, because you're paying out a lot of that revenue belongs to the creators. But like I said, don't really know exactly their contract terms, but that's kind of typically how it works. In terms of how they deliver revenue, the biggest driver by far is what they call premium advertising. This is where podcasts and Audio Boom's network endorse products natively within their shows. For example, this is the Chit Chat Stocks Small Cap of the Week, presented by Yellow Brick Investing, the #1 aggregator of high-quality stock pitches across the internet. That right there, if I were to have said that, is a native ad read. That gets counted for 55% of Audio Boom's revenue. The rest is like back catalog advertising tech, which is actually pretty cool, but it's really the bulk of this business is native ad reads. It's just how it's been for a long time, and it's still the way it is, even with the innovations that Spotify has with streaming ad insertions. Most of the time, people want to go direct to shows they really like, shows where they think the audience is what they want, and they'll pay a pretty CPM in order to get in front of that audience. So that's the bulk of their revenue. Like I said, there is the advertising tech side, which accounts for a little under 50%, but really less in a normal environment, because the iOS changes have hurt them recently. So anyways, when I keep mentioning these iOS changes, what was it, a year and a half ago now, iOS, Apple Podcasts said, we're no longer going to count downloads, which if you listen to us on Apple Podcasts, what used to happen is if you subscribe to our podcast, any new episode we uploaded, it would be automatically downloaded. For a long time, that was being counted as a listen, and it was being paid for by advertisers. Today, Apple has changed that, and now it's, I think, like you have to listen to the episode for, I believe it's 60 seconds for it to be recorded as a listen. So the reporting changes led basically every podcast publisher to have a huge drop in listens. Audio Boom was no exception. And so it really hurt them. Gross profits actually went negative for a while because of the minimum guarantees that they had to some of their largest creators. But I think they're at a point now where listens should continue to grow. They've lapped the iOS changes. Revenues starting to grow again. And hopefully gross profit margins should be sustainably above zero for a while. And they also renegotiated a lot of those minimum guarantees. They have a market cap of $53 million. They say their adjusted EBITDA flat, which we run a podcast. You should be profitable. You can be profitable at $100,000 in advertising revenue. Honestly,
Depending on your salaries.
It is. What are our costs? Okay, a mic, a Riverside subscription,
video.
If you edit your video, maybe an Adobe subscription, it's very little costs. So I'm not sure how they're not profitable, but they aren't.
It depends on how, like show notes, social media stuff, any sort of transcripts. It depends on what they're taking on versus what the show's taking on. Now, if they're only a advertising marketplace, is what you'd maybe call this, then yes, that's very low. But if they're providing these other services, the unit economics should still be strong. I'd be interested in what the balance sheet looks like, but I have no interest in this stock. I don't know why they target the largest podcasts, because the largest podcasts, as you mentioned with that minimum guarantee stuff, don't necessarily need them. The advertisers are going to come to them. Smaller is more important, and potentially, similar with all the media stuff with YouTube, that's more profitable. I'm going to show you one though, Ryan. Go ahead.
Nice. It's nice if you're the creator, if you're the Joe Rogan, which, by the way, buying podcasts outright, it doesn't really make sense. That's why Audio Boom does this network stuff. it also does not, the incentives aren't really aligned if you buy them. So, like a Joe Rogan, for example, it's nice if you have someone that can take that work off of you where you don't have to go out and get the advertisement and stuff like that. But you don't need to pay a network to do it. You can pay like 1, 2 people to go out, get advertisers who already want to advertise on your show, to edit, to publish, to distribute. Yeah, I think the strongest economics are not in the largest shows.
Yeah, because even if you had a large show, you probably need, excluding the host, you would want one producer and maybe one person managing advertising slash promotions. And that's not too expensive of a salary. If you're doing 10, 20 million in advertising revenue a year. But I want to show you this one, Ryan, it's a stock that is a similar business model, Acast, another someone that produces, owns, buys, does advertising for podcasts, I think more focused on Europe. It's a Swedish listed company. Gross profits grown at 52% annual rate since 2018. And it's much larger here. I think this would be, let's look at USD. 60 million in revenue over the last 12 months, but operating loss of $14 million. I just think it's a tough business. It's a hard business. There's a reason Spotify's not failing, but kind of struggling, even though they have the most users outside of maybe YouTube. Depends how you define that. Yeah, it's tough. It's tough. No interest in this.
Yeah, I agree. Even though we are trying the business ourselves, I mean, it makes more sense to have a lot of individual small networks than to have one that works with all the big ones. Like, if you can be a successful independent podcast, it's a big moneymaker, and there isn't as much incentive to work with a big network like that.
Yeah, and with ours, we do help advertising with other people, but they're all podcasts and any sort of independent media operations within the investing space, which makes sense because there's a niche where advertisers are specifically looking to find people that are interested in investing. All right, let's get another topic, Ryan. And I want to talk about, did you see Scottie Pippen?
No.
All right. Do you know who Scottie Pippen is? Because I know you don't follow basketball very closely.
Yes.
All right. For any of our European, I know we got some international people that might not be interested, but number 2 guy on the Chicago Bulls during the championship runs with Michael Jordan. And here's a tweet he had in November 12th, 2024. So 1 day ago, when we're recording this, Scottie says, Bitcoin in 2024 is giving me flashback to the Bulls in 1991. ... A dynasty just starting. Get ready for what's next. Time to hire. I think we hire him as our quant. This is our guy.
They're, to me, one of the biggest red flags that sends me running to the hills on any asset, any investment. And I'm saying this as someone who played college sports, because you kind of experience it, is when athletes that do not focus at all on that realm get into it and become sort of the like spokespeople for it, the brand ambassadors of it. Like when athletes get really, really into something, it feels like you got to run away.
Yeah,
I'm sorry.
well, Ryan, I'm going to show you this tweet from September 3rd of this year. Scottie Pippen says again, Satoshi Nakamoto visited me in my dream last night and predicted that hashtag Bitcoin would be at $84,600.50 on November 5th, 2024. And then he finishes with the obvious, not financial advice. And then he responds with a bull, all caps, ish, like the bulls, on hashtag Bitcoin rocket ship. Bitcoin hashtag bullish on game 5 ball, hashtag ball. Let's see what the game ball is. You want to investigate this? Here's what it
No, you
says
know
on
what?
their Twitter profile. 33 years later, the game 5 ball from the Bulls' first NBA title is now trading on hashtag Ethereum.
Oh,
Ryan, the
is
bull
that
market's
his? Is he
back.
trying to sell it?
I think it's an NFT.
I know. Is it like he created the NFTs, just trying to
Yeah,
sell it kind of thing?
he's probably doing something. Think about that dream one though. It was right.
Yeah. Wow. Okay. You know what? Maybe this shows you that, like, if they're a little crazy, they might be incredible athletes. Maybe you need a little crazy to be a great athlete. Maybe that's it. If you're just a value investor, you're not gonna. You're gonna be a bench warmer.
Yeah. Oh yeah. Someone said in the comments here says, "Beam me up, Scottie." Yeah. All right. Sounds like we
That's
need to get up
crazy.
there. He's operating. Scottie Pippen's operating on a different level than us.
I hate. I hate it when athlete involvement and investment. Like, absolutely love athletes investing and building themselves a retirement because your career, you have a short shelf life. But
No, when they get on scams, I mean, Tom
yeah,
Brady, like they convince people to lose a bunch of money.
yeah,
We had Russell
like
Okung, famous Seahawk, from our team. Unfortunately, he's a huge Bitcoin guy, and he started dunking on people because he took, quote unquote, took his salary in Bitcoin back in 2020, which he got paid in dollars and then bought Bitcoin. So,
it's also
magic.
What an irrelevant, what an unnecessary thing to do. Like, your salary won't change because it's in Bitcoin. You can always just like take the
Buy
same
it.
salary and buy Bitcoin. That's what they're gonna. Even if you want them to be the ones that pay it,
Yeah.
it's still going to be the same nominal value, or the US dollar value. So yeah, it seems weird to me. At least in his case, I assume he was not paid to promote that.
That's true. I don't think he was.
He's just a believer.
Scottie is
Same with TB12.
yeah,
A
TB12.
stain on an otherwise perfect career.
Yeah. Yeah. Yeah, some would say. All right. Well,
Thoughts
Bitcoin's
on
back.
Prologis is the next
What
question. Do you know what Prologis is?
is Prologis growing revenue 50% year over year with negative gross profits? If not,
No,
then
I
I'm
think
not interested.
it's like one of the largest REITs globally. It's like an industrial REIT.
I don't care about REITs. I'm 27 years old.
Hey, impressive returns here, actually, if I'm not mistaken. It could be actually just a
Max returns since
equity.
2001. No, 1997. It's up 404%. Now let me look at total return because they're obviously paying on a lot of dividends.
Is it? It is a REIT, isn't it?
Yes, it looks like a property manager. Let me look. Total return.
10-year total return, 277%. That's fine.
That's fine.
Solid.
I'm gonna do max. Going back to, I guess it only has 2011. Total return 407%. That's from 2011. That's the absolute bottom in properties. Yeah, look,
It's good.
it's fine.
But it's just not a
Fine.
business that I know particularly well, feel like I have any sort of edge in, so probably not something I'll end up investing in, but I've heard good things.
If it's a well-run property REIT, it is probably going to be hard to lose money. But it just depends. Are you in a stage of your life where that matters the most?
Yeah, that's a good point. Okay, we just got done talking about extreme valuations pretty much across the board. Question for you, general question. Any stocks that we haven't discussed on the show recently that are piquing your interest?
Piquing my interest. Well, I'd say the one we came out with on Wednesday piques my interest a lot.
That nothing we've discussed on the show recently.
Oh, nothing that we've discussed on the show. I thought you said the opposite. Sorry.
What are you hoping to do more research on here, Sin? What do you feel intrigued by?
Mexican stocks. US I'm finding very few US stocks that are attractive.
That's fair. Yeah. And so here's the thing that's interesting. President Trump, or soon to be President Trump, president-elect, I guess, this is kind of one of the worst things you could have before you've
Oh,
been
for that,
put
yeah.
in office.
Really.
If you, because he is someone who has benchmarked himself by stock market returns in the past. This is not what you want prior to you starting your term, because it's going to make
Mhm.
it harder to generate really strong returns by the time you are coming out of office. Whatever, doesn't really matter. But
Yeah, but it doesn't matter. I love it. The politicians can, you know, like, they have very little effect, I think, on the underlying economy, especially a president in a short amount of time. So, it's almost luck of what you can take advantage of. Yeah, we don't need to go through a whole discussion on that. We have a comment that says, "I had a dream that Sundar Pichai came to me and promised Goog to 500." All right.
that's gold.
What's the
Yeah.
old Succession, quote? "So it be, so it said, so it shall is," or something like that when he was in
Oh,
the court hearing.
cousin Greg. Yeah.
Yeah. We got a Mr. Seymour Duck, uh, saying, "Mexican and Swedish stocks for me, European stocks have been dipping." Yeah, you know what's one that interests us that we did talk about on the show a while back? Hape Group in a big drawdown because of some regulatory stuff. Yeah, Swedish company, nicotine pouch space, new age nicotine products. Seems quite interesting to me.
I also thought Evolution Gaming was pretty interesting.
Oh, yeah, yeah.
And we had a conversation which will come out next week, um, with a friend of ours named Fabio from Capital Mindset. And after our conversation, we were chatting, and he gave some additional context, which I kind of forgot about, which is I kind of look at Evolution. I think of it mostly as a tech stock, like it's building out tech platforms that casinos use. A lot of companies, a lot of people can't invest in it because of of certain policies around it being a sin stock, um, helping enabling online gambling. There's a lot of funds with mandates that say we can't buy it, which kind of gets that sin stock discount, which is nice if you're share cannibal.
Where's the sin stock discount in 2020?
What do you
I'm
mean?
curious. For
Where was it?
Evolution. Yeah, where was it?
Yeah, that's a good. That's a good point. Was it that expensive?
Yeah. Yes, it was.
I
It
thought
was
I remembered it at like 25 times earnings. Or did it
you're
get
thinking
more
25
expensive than
times
that?
sales.
Well,
Um,
sales and earnings aren't that far off. It's got like 70% margins.
well, let's look because I believe it was at 70
Something
times
crazy.
earnings. Trying to load her up right now. Then we can head out of here. Okay, loading. Price to sales. You want to use price to sales?
Yeah, but I mean, you could just use earnings.
Price
Should
to
be fine.
sales peaked at 50.
What was the earnings? Must have been like 70. Yeah. Oh, no sin stock discount there.
No. Peaked at 90.
Oof.
Yeah. Multiple compression is not fun. Not
No,
fun. All right. I think that's everything. Have anything else before we get out of here, Ryan?
I think that's it.
All right. Great episode. Thank you, everyone, for joining, talking about stuff. I think it's a great time. We're going to try to cover some hopefully undiscovered stuff on the show. We're also talking about all the things people love about in future episodes. There'll be small caps that we do deep dives in, interviews around that, as well as popular stocks as well. So keep following us on Spotify, Apple, YouTube, wherever you get your podcast, and we'll have something for you, even if you don't listen every week. As a reminder, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast. They have held them in the past and may buy, sell, or hold them in the future. If you like this episode, give us a review on Spotify or Apple Podcasts. It takes you 10 seconds and is the best way to help us grow. Thank you, everyone, for tuning in live, listening to these replays on YouTube, Spotify, or Apple Podcasts, and we'll see you next time.